Is the market about to come crashing down? Let's do the analysis. And let's be mindful here. There are lots of people that are constantly making bearish content because there's always things that you could pick out or data points that you could pick out that could make you feel bearish on the market. If you wanted to build a thesis at any point in time, you could, if you only focused on that data. And there's people who get big followings and tons of views by constantly making bearish content. And what they don't do is make money. And what they also don't get is my attention. It's a great way to lose money and lose brain cells listening to people who are constantly bearish. Okay. They're dumb-dumbs. And then oftentimes they're really smart people and they overthink everything and they don't make money. So, we are going to instead listen to some theses of people who are typically bullish, who have proven that they're really good traders, that are really consistent, and we're going to hear their thoughts on the market. We're going to kind of compare it with what I'm thinking right now as well, after doing a revalue, after listening to what their arguments are and doing a revaluation. Now, what we have here is my Substack article that I wrote when I initially did this research. Some of you might have seen this video already because I posted it yesterday, but the audio was bugged, fixed it, and now we're going to redo it. Now, the main person that we're going to be listening to today is Dale Pinkert. Dale is a longtime trader, really great guy, really love Dale. So go check him out and go check out his company, TraderGate Hub. Cool stuff. Cool guy. Very smart. So let's talk about Dale's bear thesis right now. Dale thinks the bond strength, first of all, as a bear market rally and not a secular bull market. So he kind of sees that we've got this wedge breakout and he's looking for the collapse here. So he's looking for this maybe to drift up a little bit higher to 92, 71 and then kind of roll over. Oh, well, at least that's the key level that I currently see. I'll say right off the bat, let's get this over here. When I look at TLT on the daily, I see strength and good confirmation on the weekly. So like we have the confluence here along the major time frames, and this does look really great to me. And the monthly now is starting to also get out of this downtrend as well. When I look at those like long-term momentum indicators to kind of understand how does the underlying look. And where is the trend? We're breaking out of major EMAs. We broke out of that wedge, of course. And this to me looks really strong. So, you know, if I were going to take calls, I would definitely be willing to take some calls over 90 and look for an extension higher to this next key level at 92. Now, if we get this full move to play out and turn over at 93, that would be pretty unusual, in my opinion. So, well, I'm a little bit more on the fence. I don't have strongest convictions, but this one seems a bit off to me. I don't see it yet. He points to this, though, being the case as he looks at the 10-year rate. He flags the risk of a hawkish cut. So while the Fed is easing, the yields refuse to collapse. Remember, the Fed can set their rate, but it doesn't really set the rate for the market. Okay, market decides its rate. So the Fed can cut all day, but if the bond market decides that America is spending too much money and interest rates need to stay high because of that, it cannot react. So, and there could be just no demand for bonds either. If there's like a lack of trust geopolitically or whatever, there's a few reasons why you could get that effect. And he's basically thinking that you could not see bonds get out of the hole and the long tail end, the longer maturities. Keep in mind, TLT is 20-year plus maturities could not get a reaction, even if shorter date maturities still find a reaction. Notes that it's rare for the Fed to start cutting stocks at all-time highs and expects a correction before any melt up. His base path is the S&P to hit 6,000 before 7,000. So just for reference, we're currently at 6,600 right now for the market. Looking very strong, maybe too strong at the moment. It was very extended and it's starting to lose momentum here as it fails to break that previous high, but still up there. It's still basically at all-time highs. And he thinks there's a non-zero chance of hitting 5,600, which would be, we didn't want to do that, which would be a very dramatic plummet down to the fourth wave. So if that, so the main thing he's watching is this wedge on the 65 minute, and he's looking for us to fall back into this wedge and go further to the downside. Keep in mind, he put out that video, I think, was created on the 6th, so we're still basically in this range. And he's looking to see if we can plummet back down to this. Remember, it's a big week too. It's a big week to make a prediction like this, because we have the interest rate cut, which everyone's super bullish into, and he's basically saying that he thinks the market is fully priced it in, and that something's going to derail the bulls here, and the panic is just going to build upon itself as everyone's mispositioned into that rug. His thesis is that under the hood leadership is reign. He's saying the video looks weak, Amazon or Apple are lagging to recent highs, Netflix looks vulnerable, and that he says this is part of a greater rotation, but he still prefers indices over single names. Okay, so he is still trying to pick, or he's still just trying to play the indices over picking out single names. So that means he's going to probably short SPIX, or he's going to short QQQ. And he is saying, don't FOMO into it, don't front run it, wait for the trigger, and then trade the signal. So MBT on a long term, I think we're in a financially dominant regime. If the US is printing tons and tons and tons and tons of money, you're being a fool if you're trying to fight that, and you're constantly shorting this market. We've made a lot of money just saying follow the trend. Trend goes higher. We'll keep following that trend, and up we go, right? We're not really playing the game of, trying to time tops most of the time, which I'll talk about more in a moment. It's fueled by credit, and the government pretty much has an endless money printer. And so at the beginning of the year, there was a sentiment of seeking fiscal responsibility and starting a tariff war. And then we saw that crash in April. And then once the bond market started to break, Trump gave up. He immediately went back to money printing, dropped a huge bill, cut corporate taxes. That is insanely bullish. It's the exact opposite of everything that he started out doing. He went to save the markets, and now he's trying to pump them higher and higher and higher. And now the Fed, on top of that, is cutting rates. Okay, so if we actually look at a study that JP Morgan did, the last 12 times the Fed has cut when the S&P was within 1% of all-time high. The index was higher 1 year later in all 12 cases with a median of 15%, which is not insignificant. Remember, stock markets tend to average 10 to 12%. So it's above average performance and out of those 12 out of 12 cases, and it was always up. Out of all 12 out of 12 cases. If you go back further, I think there's just under like 20 times that this has ever happened in history. And I believe they were all bullish. But that was a good, interesting, if you want to Google that, you can Google that and read it. It's a very interesting study. Practically small caps carry a multi-year cup and handle. So when I look at the small caps right now, they want to go higher. When we get this break on this cup and handle, you're going to want to be long. You're going to want to chase with size. I mean, an absolute massive move could come. Remember, when small caps start to outperform large caps, they don't beat it by 20, 30, 40, or they don't beat it by just a little. They beat it by 20, 30, 40% massive moves, right? ETH is probably the most bullish thing in the market right now. We have this monthly buy signal that's printing right here. We can see every time we get this monthly buy signal, we get huge pumps out of Ethereum. So that's something to also keep in mind. Gold miners are breaking out right now, which kind of enforces my thesis that we're in this monetary debasement because we're printing tons of money. There is a underlying idea of stagflation here as well, which could be thrown off by recession. But so far, I think everything's intact, and that's for looking for the end of a bull market. Some will say, which Dale doesn't think so. He said his target was 7,000 in the long term, which I actually think personally would be our most conservative target. We would expect something higher. We can see that GDP has cooled. Even though GDP has cooled, it just looks like normalization. There is weakness in the middle class and all of that, but this is actually just fitting into a K-shaped economy where the upper class grows, lower class grows as well. So even though they can look awful and sound awful, markets continue rallying because the rich are getting richer, because the government's just transferring more money to them and trying to support the market, right? And then if we look at the overall fear and greed index, we kind of measure sentiment. You know, if we were looking for a high or the end of the bubble, we would want to see this at extreme greed. I want to see people running around doing victory laps, but we're not seeing that at all. In fact, the market being neutral is very, very, very bullish long term. So then let's kind of put together what's kind of happening economically. And for this, I think the most important people to listen to right now are Danielle Booth and Anna Wong. They're two economists that were very early to the idea that there was going to be labor market weakness back before we even saw the major revisions. So they've been talking about this coming since about 6-7 months ago. So they're highlighting that the headline payrolls reported can mislead while average weekly hours stall first. The average work week has hovered around 34 hours in recent months, and that stalling in hours is a leading tell because firms cut hours before cutting heads. This is something really interesting that I had not thought of keeping an eye on in the past. This idea of like, don't worry about cutting heads. I've always known that job loss was a lagging indicator, and that typically when there's massive job loss, you're probably already hit the bottom of the market. So it's not really too important to watch as a trader. But watching for hours depreciating to understand when that's coming is a really interesting metric. Not sure how you get that info, but they have it. Yeah, so the magic average worked in manufacturing is a leading component. Super fair. And, you know, keep in mind that this is happening while we're pushing for more manufacturing in the U.S. This doesn't seem to be working. Maybe we'll see a big turnaround that kind of dismisses all this, and that kind of what fuels the market later on. It doesn't really help us in the immediate, though. She warned of a private sector recession risk. I think the private sector has been in a recession. You know, lots of people don't realize that what's probably going on, and probably in an oversimplified explanation, is that the biggest hedge funds and angel investors are probably pushing the government to lower the bar on accreditation to do private investing because there is such low liquidity and the market is struggling right now. Keep in mind, private investments typically outperform public investments, and that actually hasn't been true in recent. So there's probably a push to get average retail into private markets to provide liquidity so that people can take profits. So basically, there's a push to generate more exit liquidity for them. Not a good thing for the average person, but in the long term could be a great thing. And as Wong's team at Bloomberg Economics has been vocal that a labor market softening shows up in forward indicators in sector canaries. One public signal from Wong is that construction payrolls, her team's leading indicator, points to cooling with a 7-month lead time. So it's an actual leading indicator rather than job loss, which is typically a lagging indicator, which we kind of talk about in this article later on as well. So this is all important to keep in mind because basically you have to remember that when you're in this environment of stagflation is not a long-lasting it's a transitory period. That's what I'm trying to say. Typically only lasting 6 to 18 months. And so as a trader, and especially as an investor, when you're in a stagflationary period, you want to be looking for how does this resolve? Because it doesn't last long. Even bear markets don't last long. Typically a little bit longer than this. But you want to look for, where does this break? Does this break further to the downside, turn into a depression, or in this case, a recession, or do we break out to the upside and everything's fine? And so when you're talking about something like the gold breakout that we're seeing right there, and gold's mooning, if there is a recession, and Dale is correct about his thesis of a market rug pull, which will probably coincide with what the economists are saying, the smart ones, then we could get a rug pull on the market, and especially gold could be taken out as well. And there's probably I've seen lots of victory laps in gold. Gold is probably one of the things where I do think sentiment is starting to get a little bit frothy. So where do we take all this and find a middle ground? Where do I agree with Dale's bear thesis? Okay. Despite the fact that I don't think TLT is bearish or just in a bear rally yet, I don't see it on the chart. I can agree that when we look at 10-year yields, we are just in a wedge with no real break. So there's no real signal formed here. And you really do want to see that signal clarify before you can say anything with major confidence. When we talk about the rotation, basically, this one's a bit tough because we had, let's see what the market, how we finished out today. So, that tech weakness he's talking about really came and solidified it, reversed today. There was a lot of strength in tech. There is still a lot of weakness in NVIDIA. Netflix did have a bounce not very convincing, honestly. If we're looking at NVIDIA right now, this still, in my opinion, looks definitely like an ABC down, which is why I have this fib set up like this. And then within this, of course, you want to see like ABC structures, and we do perfectly see those AB structures. The fibs within them as well are very strong. So I think what we're likely going to see is something like this. I think this bounce might have actually completed here, and then you're probably going to be looking for 1075. So I actually agree with Dale. I think Netflix is looking really weak right here. And today I got short on Netflix as well. But it's important to understand that rotations are good, and they can actually be very bullish to see kind of money diversify out and different sectors run, so that the more things that are going up to the upside, the less likely you're kind of in like a very localized bubble. Lots of people are worried about how hard NVIDIA's valuation has grown, but the market has broadly been moving. We just talked about how small caps look extremely bullish right now. Small caps start running, and mid caps wake up, because mid caps are actually what's underperforming the most right now. That's actually very healthy for the market. It still is likely a bubble, a credit bubble for money printing that's unsustainable. Robotics and AI could extend that further, which is something that could also be leading to the job loss that needs to provide some nuance in the conversation that historical evidence won't provide. But right now, in this moment, breath looks okay. It didn't look okay this morning. But by the end of the day, it was looking a bit better. I will still say that we are probably, if we look at SPY here and we look at like the 65-minute, earlier today we were probably definitely extremely overbought, but we had like a bit of a bullish divergence. If we go to the 4-hour here, at one point in the day we were more overbought than we had been for the entire year, and that kind of also solidified itself as the market kind of pulled back a bit. So we'll need to just keep an eye on this. Dale could be right and we could see a rug pull, but so far it just looks weak. It doesn't look terrible to me. And if we consolidate a bit longer sideways, if we go straight up, I think that actually strengthens his case because pullbacks are healthy. So the more straight up we go, the more bearish I'm going to get and start to agree with him. This is going to be like a day by day. It's a kind of a precarious spot for the market, especially since it's probably one of the biggest weeks we've had in a few years, since we're changing from an environment of fiscal easing to fiscal tightening. So if we went straight up, I would be I would be getting more and more short if we go straight up here. If we trade sideways, consolidate, my indicators get healthy again, I'm going to get worried. If we have a small pullback and then start to bounce off important EMAs, I'm going to get long again. That's the way I'm looking at it right now. I need IWM to actually get a trigger, by the way, for that cup and handle. It needs to actually break the cup and handle. So when we're talking about where are some wild cards that can really throw this off, the sanction talk on Russia, Trump trying to get the EU involved, if that leads to any escalations, that can definitely throw the market off. So I wrote this over the weekend that the tariff pushes on China and trying to get the EU to get involved, that could cause an escalation. But Trump actually tweeted some positive stuff about that today. He said it's going well. We'll see how that turns out. We've been hearing that's going well for about 60 days. Remember, remember, it's like 9 weeks ago we heard we were going to buy TikTok and we were going to hear the TikTok buyer in 2 weeks. I think that's what he said. So you just got to take it all with a grain of salt on what the timeline's going to look on stuff like that, or if it actually is going well. And then, of course, you have the political unrest. We had the assassination of Charlie Kirk, and there's a lot of people posting extremist things on social medias. And even hedge funds have kind of gone through and tried to figure out how many people were posting extremist things, because a lot of people were losing their jobs over their tweets about this instance. I don't think it's significant, but it's a little bit of dark humor. Bottom line, I think Dale is right overall and looking for a short-term top here with the market. And if we do some Elliott wave analysis here, we've always had this wave 1, wave 2, and then the wave 3 here has been a bit precarious. So we want to draw our extension tool to the levels here. And we can see that there is definitely, let's see, we got that right. There we go. We could definitely see that there is a scenario where we actually get a further extension to 6,700 before the market actually get a pullback. We complete this Fibonacci. Now remember, these are more suggestions than a science. And there might be, the wave count might have changed within here to change this trajectory. Originally we had our third wave coming here. We were looking for a top right here. We ended up blowing right through it. This could be an instance where you blow right through this one. You look for 7,300. But that's actually where I currently see the fifth wave. I actually think I need to adjust this a bit higher. So if we did crack here and we started looking for the plummet back to the downside, a nice 618 retracement here on the SPIX would bring you right nudged nicely at the 6,045, which is Dale's target. A move further down to 5,600 would be interesting. That's the 38.2% retracement. This is probably what Dale's generating that from. From my analysis and subwave analysis, think we're probably going to sit right in this box right here, and we're not going to see that dramatic plunge. But of course, if any of those wild cards happen, maybe that's what will actually give that 5,600 retracement. So what am I actually doing right now is I have some small short positions on and I've started to take a lot of my gains off the table as the market looks extended. Still playing some individual names and doing my day trading, looking for those daily moves. But overall, this week into such a big week with such a big event on Wednesday, I think it's time to sit back and say, okay, I've made a lot of money this year because I've been long, and I'm not one of the people who are just making content to engagement bait with bearish rhetoric that helps no one and makes no one any money because it's dumb. I instead am an actual trader who's made some really great money, although it does not generate the same equivalent amount of views, which is hilarious because most people don't make money in the markets, and that's just a perfect representation of that. Even when we look at the Dale's interview, Dale's been a trader, institutional trader, and he's been in markets for 50 years, 60 years. And this video has 3,000 views, 3,200 views. That is pathetic. I could pull up, I mean, we can just do it just for a laugh. But if we pull up, I think one of the most favorite, Steve Van Meter. Look at these videos. Bearish. Actually, let's do this. Look at this. Bearish. Get out now. Hell is coming. WTF. World changing alert. What just happened? Urgent warning. For weeks and weeks and weeks and weeks and weeks and weeks and weeks. Do you think the people watching this are making money? They aren't. Okay. This guy's just picking out stuff that doesn't matter to try and build a thesis that is definitely wrong. And way more views, way more subscribers, way more useless. But hey, that's what happens. Most people don't make money. So that's where I stand. If you found this helpful, make sure you definitely go to the description on YouTube and click to subscribe to the newsletter, because typically I don't make videos about stuff in the newsletter. It's the almost daily newsletter with lots of helpful stuff like this and analysis, and there's some stuff in there I breezed over. So if you want to go read through it, go subscribe, and I share lots of trade ideas in there and analysis. That's all I got, guys. All right. Have a great night. God bless.